In this screencast, we will be discussing Chapter 9's problem set, specifically question number 2. So as we kind of get into this problem set, I wanted to first define a very important part of this problem, and I wanted to define a contingent liability. So the definition that I found for this term is a liability that may be incurred by an entity depending on the outcome of an uncertain future event. So we're given this statement here up at the top, and this is how question 2 starts off by telling us that several independent items are listed for which the outcome of events is unknown at year end. So then on this next slide, we will look at the list that we're given for question number 2. A states that a company offers a 2-year warranty on sales of new computers. It believes that 4% of the computers will require repairs. B says that a company is involved in a trademark infringement suit. The company's legal experts believe that an award of $500,000 in the company's favor will be made. C states that a company is involved in an environmental cleanup lawsuit. The company's legal counsel believes that the outcome may be unfavorable, but has not been able to estimate the costs of the possible loss. D states that a soap manufacturer has included a coupon offer in the Sunday newspaper supplements. The manufacturer estimates that 25% of the 50-cent coupons will be redeemed. And finally, E states that a company has been sued by the federal government for price fixing. The company's legal counsel believes that there will be an unfavorable verdict and has made an estimate of the probable loss. So as we break these down in these next few slides, I first want to focus on some of these key words that are in statements A through E. So you'll see that some of them, most of them actually include words like believe and estimates. So as we go throughout these next few slides, refer back to these statements A through E and really pay attention to the wording and the verbiage that's used as these statements are described. So the questions that were asked, the requirements here for this question number 2 are, number 1, identify the items A through E that should be recorded on the balance sheet at year end. And then secondly, identify which of these items A through E should not be recorded on the balance sheet, but should be disclosed in the year end financial statements in those notes. So first we're going to look at statement A. Statement A says that a company offers a 2-year warranty on sales of new computers. It believes that 4% of the computers will require repairs. So the contingent in this case is probable, as we can tell from the statement, and the expense can be reasonably estimated. So our answer for A is that this item should be recorded as a liability on the balance sheet at year end. It's a really easy giveaway when you see that word believes, and it's also, part common sense, just understanding and being able to estimate certain expenses or costs. Alrighty, so moving on to statement B, a company is involved in a trademark infringement suit. The company's legal experts believe that an award of $500,000 in the company's favor will be made. So this item concerns contingent assets. So remember we talked about on that first slide, defining what a contingent asset was. So this will not be recorded until the actual gain of $500,000 occurs. So this item should not be recorded as a liability on the balance sheet at year end. Moving on to statement C, a company is involved in an environmental cleanup lawsuit. The company's legal counsel believes that the outcome may be unfavorable, but has not been able to estimate the costs of the possible loss. So we interpreted this by saying that the cost of the possible loss are not estimated. So for that reason, this item should not be recorded on the balance sheet at year end, but it should be disclosed in the notes in the year-end financial statements. So statement D, we have a soap manufacturer that has included a coupon offer in the Sunday newspaper supplements. The manufacturer estimates that 25% of the 50-cent coupons will be redeemed. So again, you see those keywords of estimates Typically, it's a pretty dead giveaway for this item to be recorded as a liability at year end. So because the contingent in this case is probable, the expense is reasonably estimated as seen. The estimate they give us is 25%. This item should be recorded as a liability on the balance sheet at year end. And so finally, we have statement E that gives us a company has been sued by the federal government for price fixing. The company's legal counsel believes that there will be an unfavorable verdict and has made an estimate of the probable loss. So the contingent in this case is probable, and the probable loss can be reasonably estimated. So this item should be recorded as a liability on the year-end balance sheet. And this is a tricky one because it does say that there will be an unfavorable verdict and has made an estimate of the probable loss. And even though it's an unfavorable verdict and it might not be a gain, you are still able to make a reasonable estimate. So our compiled answers for you, just in case that was kind of hard to follow, items A, D, and E, because the liability is probable and an estimate is available, they should be recorded on the balance sheet at year end. And then we've got item C, the liability is reasonably possible, but an estimate is not available. And then item B is not recorded or disclosed because it is a contingent asset. And a contingent asset, remember, is that first thing that we defined on those first few slides. So kind of just some takeaways for you guys. I thought that these would be great questions to ask yourself when you're contemplating this concept, right? Should I add it in my year-end balance sheet? Should it be included in the notes in my income statements at year-end? And so these just a couple questions hopefully will help you as you're contemplating these questions. So is the liability probable, right? Is it possible? And a lot of times, really, aside from the numbers, it's just the wording in these statements that they give you. So, like we talked about, the word believes, or sometimes it'll straight up tell you that something is probable or not. Is there an estimate available? As you can refer back to statement E, it talks about how there was an estimate of 25%. It really does just kind of spell it out for you. So those are pretty big red flags when thinking about these questions. And then lastly, does it concern a contingent asset? So if it does concern a contingent asset, you can actually rule both of these out, and you can just kind of confirm that you will not record either on your year-end balance sheet, and you won't include it in your notes at year-end either. Thank you guys so much for watching. I hope this provides a little bit of clarity. Have a great day. Thanks.